Most investors think they understand asset class performance because they remember the recent winners. They remember the S&P. They remember tech. They remember the gold surge, right? But markets do not reward memory. They reward context. The chart on the screen, asset class returns across eras, is not a performance leaderboard. It's a map. It's a regime map. And if you misread this chart, you will basically misallocate capital for the next decade. We're going to do three things today. How to read this chart carefully, first of all. What changed structurally after 2010 and again after 2020, and why diversification failed recently and why it may work again very differently. This is not about chasing return. This is about understanding risk, again, volatility, and regime dependency. So before interpretation, mechanics matter. So let's understand how to read the chart. Each bar represents an asset class. Global equities, global sovereign bonds, corporate bonds, gold, private markets, and real estate. Each section of the chart represents a time. You have 1990 to 25, 2010 to 25, 2020 to 25. Now the most important part, left to right, the return. Obviously, when it's blue, and each of them at different colors, right? You could see where it moves. Now you will note that each period ends 2025. So 1990 to 2025, 2010 to 2025, 2020 to 2025. So what does it mean? Well, the length of the bar shows average annual return. The dot marks the precise percentage. So obviously, the wider it is, the more money you make. Next, in the far right column is a volatility. Volatility measures how violently returns fluctuate. Higher volatility equals higher emotional and capital stress. And volatility is not risk, but it's how risk is experienced. Hope this is clear. Okay. Right, on the right side, see the volatility? 14%, 5.8%, 5.3%. You know, how much volatility did you have to suffer to get that return? So the chart is not asking what returned the most. It's asking what returned the most for the risk taken and in which era. That distinction changes everything. So let's start with the longest lens. 1990 to 2025. Global equities, 8% return, 14.7% volatility. This is your classic equity risk premium. Strong, but not magical, right? 8%. Then you've got the sovereign bond, 4% return, 6% volatility. This includes disinflation, falling yields, massive duration. Bonds work because rates fell for 35 years, meaning that you had a lot less volatility than equity, and the return wasn't too bad. You know, you only lost maybe half, but you had a lot more volatility drop, so you were getting paid better. Corporate bonds, credit delivered equity like returns with 5.6%, with bond-like risk with 5.3%, because defaults were suppressed by growth in central banks from 1990 to 2025. And gold kind of did its job at 6.7% return. No cash flow, no growth, pure monetary hedge, but the volatility was quite high at 15%. Real estate, 5% return, again, 15% volatility. A real asset that worked when rates fell, Leverage was cheap and demographics were favorable. The key takeaway: diversification worked because macroeconomic forces were stable and predictable. But that world is gone. Now let's take a look at the new era, not 2010 to 2025. Now here's a distortion that begins. Look at global equities, 10% return, 15% volatility. This is not organic growth. This is QE, buybacks, and multiple expansion. Take a look at the corporate bonds, 3.1% return. Almost no return. Gold, 8.6%. Gold outperformed bonds. That should have been a warning. Look at real estate, 6.6%. Again, rate driven, not income driven. Key takeaway for era number 2. Returns became policy dependent, not productivity dependent. And this is what's building the systemic risks that we're having currently. Is that the government is everywhere. The government is creating inflation by spending so much money. And it's involved in humongous amount of debt issuance, which is making the system very unstable. And of course, since they're all on crack, the market assumes more government intervention. And it's not just the US. Finally, 2020 to 2025. The regime break. That is where most investors are still confused. Global equities, 12% return, 16% volatility. Looks great, but concentration did the work. A handful of stock carried the index. Sovereign bonds, minus 1%. Corporate bonds, 1.3%. Credit lost its defensive role. Corporate bonds didn't do that well. Gold, 18%. Basically, gold did not hedge fear, it hedged monetary credibility. Then, of course, real estate, higher rates exposed leverage, Cape Rights price, cash flow failed to keep up, 1.9 return for 17% volatility. The key takeaway from era number 3 is inflation breaks diversification, rates become the dominant force, and liquidity becomes king. So what is this chart really saying? This chart is not about winners, it's about fragility. Bonds are no longer a guaranteed stabilizer. 1. 2. Private markets hide volatility, but cannot eliminate it. 3. Gold reasserts itself when trust erodes. 4. Equity returns are increasingly narrow and conditional. The biggest mistake investors make is assuming that long-term averages will save me. Averages only matter if the regime repeats itself. This one is not. This is a different environment. This chart forces a difficult question. Are you diversified by label or by economic behavior? Because in the next decade, inflation sensitivity matters, liquidity matters, correlation matters more than return. The era of passive complacency is ending. Asset allocation is becoming active again. And those who ignore that shift will earn expensively.